This is Nightly Business Report with Bill Griffith and Sue Herrera.
Corporate shakeup. Boeing CEO is out as the fallout from its grounded 737 MAX continues. What it all means for the company and for Boeing investors. Portfolio makeup. With stocks at record levels, why tonight's market monitor thinks defensive and income are very important for some stocks that she thinks you should own. And industry wake up. What the video game console business is doing to fight off competition from mobile gaming and streaming services. All that and much more tonight on Nightly Business Report for this Monday, December 23rd. And we do bid you a good evening, everybody, and welcome. Sue is off tonight. Stocks, again, close at record levels. We'll get to that shortly. But first, another shoe has dropped in the ongoing crisis involving Boeing's grounded 737 MAX. And this time, it fell in the company's C-suite. CEO Dennis Muilenburg is out immediately. Chairman David Calhoun will take over as CEO next month. And investors reacted positively to that news, sending Boeing shares higher by about 3% today. Phil LeBeau, of course, has been following this story all along. He joins us tonight from Chicago. Why now for the firing of Mr. Muilenburg, Phil?
Bill, I think there were two things that have happened within the last month that the board of directors finally said, enough, we have to make a change. The first one being that Dennis Muilenburg was called to Washington, D.C., and he was essentially dressed down by the head of the FAA. The head of the FAA says, you don't make demands. We call the shots here in terms of when this plane is safe and ready to return to the air. That was a very public meeting. Maybe the meeting itself wasn't public, but it was a dressing down.
Right.
The CEOs rarely have that happen. And the second thing happened 4 days later when Dennis Muilenburg said, we are going to shut down the 737 MAX line, at least for a couple of months or who knows how long, temporarily is the language that they used. That's unprecedented. For a company of this size, with this history, to, for the first time ever, voluntarily shut down a production line,
right,
that was enough for the board. They finally said, it's time for a change.
Quickly, does this speed up the return of the 737 MAX, do you think?
No. I think that what it does do is it probably improves Boeing's relationship with the FAA at a minimum, because already Dave Calhoun, one of his first acts as the incoming CEO was to call Steve Dickson, head of the FAA, this morning. He said, we welcome rigorous oversight. We want to be regulated. That's the beginning of changing the tenor and tone that has been a problem at Boeing for some time, and in particular, during this entire 737 MAX crisis.
We should point out David Calhoun is a veteran in the industry. He's worked at various other companies in that area as well. What will be his agenda, do you think?
Really three things. One, rebuilding the relationship with the FAA. It's completely broken, and you have to have that rebuilt. Second, they're going to do a reset on the 737 MAX. That doesn't mean scrapping all the work, but it does mean sitting down with the engineers, with the leadership, saying, where are we? What can we realistically expect? Okay, let's move forward from here. And then finally, rebuilding the relationships with the airlines and the suppliers. Those are damaged. I mean, I talked with one executive in an airline today, Bill. He said, Dave Calhoun and our CEO had a long conversation. And our CEO had a look on his face like, this is welcome. I mean, it's not going to change overnight,
right,
but this is the beginning of improving that relationship.
On what was supposed to be a vacation day for Phil LeBeau, but he came in on a big news day. Thanks, Phil. Appreciate it. Merry Christmas.
You got it. Merry Christmas.
All right. So what is the change in this leadership at Boeing going to mean for the stock? Joining us tonight is David Dietz, president of Point View Wealth Management, who is a shareholder in Boeing, we should point out. So what do you make of today's development?
Well, I think it's a positive here. As Phil was just mentioning, the relationship with their regulator, the FAA, had completely fallen apart.
Right.
That is a non-starter, really. Second, of course, you got to inject more transparency into the process of recertifying these 737 MAXs. I think this is well on its way. And finally, just some new blood to kind of defuse tensions. I think that's going to be critical here. And so I think it's a positive.
Do you want to see other change in leadership? I mean, some other executives have already left the company as well. But as a shareholder, do you welcome David Calhoun, but he's only one person.
Absolutely. And this is a short-term move. Mr. Calhoun is 62 years old. He's not going to be there for 10 years. He's also been with the board for close to a decade, so it's not a complete rechange and so forth. He's not an engineer, and I think Boeing needs to listen to their engineers a little bit more. So it's not a perfect choice, but I think the fact that, you know, when they were in a crisis situation, they didn't have a chance to do, you know, a 6-month search around the industry, and so I think this is the best they could do, and I think it's a positive.
All things considered, for what a disastrous year, PR-wise and otherwise, it has been for Boeing, the stock is only down 11% to this point, not counting today's comeback rally of sorts. What did you make of that?
Well, I think that underscores why we're bullish over the long haul. Basically, the aircraft business is growing about 5% per year. Everyone around the world wants to fly. It's the quickest way to move around. And of course, there's just really two companies that are in the business. You've got Airbus, you've got Boeing. And so there really aren't a lot of options. And you still see the backlog for the 737 MAX is staying pretty constant here. So I think over the long haul, given how much experience you need to get certification, based on how much engineering and capital you need to make an airplane, Boeing's not going anywhere. So I think over the long haul, ultimately it gets past that, and that's why there's not a bigger sell-off.
Having said that, though, you're not adding to positions. I mean, you're just hanging in there right now.
So I don't see a real catalyst. And I mean, we're down about 25% from the all-time high. Having said that, I would not urge people to sell. You've got an above-average dividend. You've got a price-to-earnings multiple that's below the market. Yet you have a company that's one of the standouts. I mean, this is America's largest employer. This is its largest exporter. So this is really the king of the hill still. And so I would hang in there for the long haul. If there's another big pullback for whatever reason, yeah, you can buy into it.
I mean, company really is not out of the woods yet. They still have to get this plane back in the air, and that's not going to be all that easy, I would think.
Well, I think that's right, but it will get recertified. And I do think this helps things because now that you have a better relationship with your regulator, you're going to get your calls returned more quickly. There's always gray areas in this recertification. I think you're going to get a little bit more of the benefit of the doubt that you weren't going to get under Mr. Muhlenberg.
David Dietz with Point View Wealth Management. Again, thanks for coming in tonight, David.
Thank you, Bill.
See you later. Well, the Dow got part of its lift today thanks to the gain in shares of Boeing. You couple that with news that China says that starting January 1st, it's going to lower import tariffs on more than 800 products, and stocks were set for another record close today. The Dow was up another 96 points. NASDAQ climbed by 20. The S&P was up 2. Bob Pisani has more on the day on Wall Street.
Big volume last week, but light trading today. The S&P moving in a very narrow trading range. Still, the markets closed the day at record highs with the Dow rising 96 points. Shares of Boeing led the way, jumping nearly 3% after the company ousted CEO Dennis Muhlenberg. Boeing has been struggling with that 737 MAX jet crisis as it tries to regain trust from regulators and customers. Elsewhere, energy stocks had a big day. Shell driller Apache Corp was up 17% after the company entered into a joint venture with Total to develop a project off the coast of Suriname. Other exploration and production stocks like Devon and Hess were up big as well. This has been a big month for those oil names, many up double digits as oil has climbed over $60. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And another area of interest to look at the end of the year, the emerging markets, which have been on a tear recently as trade concerns have come down. And while much of the focus this year has been on the unrest in Hong Kong, there are new risks for investors in this area in the new year, namely the sharp rise in protests and public backlash in other places like India, Chile, Argentina, and Egypt. Seema Modi has more.
A number of Wall Street strategists are betting on emerging markets in the new year as the risk of a trade war fades and global growth bottoms out. But experts say there is a new risk on the horizon: social unrest. In the past few months, protests have arisen in different parts of the world. Income inequality, concerns of corruption are among the issues fueling these anti-government demonstrations in countries like Chile, Iraq, Argentina, among others. In India, the protests have escalated in response to a controversial citizenship law passed by the government that has drawn criticism from many Indians. The social unrest witnessed across the country has led think tank Eurasia to downgrade its view on India. Growing political pressures facing Prime Minister Narendra Modi comes as India's economy continues to slow down. Unemployment has risen to a 45-year high. and experts caution that the ongoing protests could further weigh on the economy. Political risks in Hong Kong have hurt its growth picture. Now facing its sixth month of demonstrations, Hong Kong's economy has already fallen into a recession as consumer spending and retail sales have plunged. Strategists say if protests in different countries escalate, the economic risks will likely rise. For Nightly Business Report, Seema Modi.
Let's turn to our friend Jack Ablin to talk more about the markets as we head to the end of the year. Of course, he's founding partner and chief investment officer at Crescent Capital. Jack, good to see you again. Thank you for joining us tonight.
Nice to see you, Bill.
I mean, what a stellar December this has been for the markets, capping off what has been a pretty strong year again. What do you make of all this right now?
Yeah, I mean, it's a backdrop of lower interest rates, essentially. What we realized was that interest rates were a key driver of not only the economy, but certainly the stock market, given the level of debt that has really permeated the corporate balance sheets. Fed learned their lesson very quickly last year, reverse course, 3 rate cuts, and here we are, 30% move.
But we still haven't had one of those proverbial 20% pullbacks that everybody feels is necessary to clean out some of the dead wood in the market before it can reset and go higher again. We just keep going higher and higher.
That's it. I mean, you have, with the low interest rates and a friendly environment, you have companies, like Sears that probably should have been out of business 5 or 6 years ago at least, still, with more than 400 stores. So, I think there is some catharsis in a washout. We haven't seen it yet. My sense is it'll be precipitated by higher interest rates. I'm not sure when that will occur, but given how leveraged we are to debt, so to speak, any higher interest rates will push things lower. I don't see that around the corner, but if we get some inflation, if we get stronger growth than we expect, that could be a risk to the stock market.
Once again, technology was a big leader for the markets this year, and again, concentrated in some of those big FANG stocks and a few others as well. Is that where you see growth for next year, or where do you see opportunity in 2020?
Sure. I see, I don't see a repeat of the 30% growth. Keep in mind that, the earnings backdrop was only up about 3% this year. So clearly it was all PE expansion, valuation extension. Next year, analysts are expecting 6% growth in earnings. If we get no valuation expansion, then we should get around a mid-single-digit return for next year, all things being equal. Remember, an election year is generally a good one. Policymakers don't want the wheels to fall off the apple cart going into re-election, so they're going to try to stay pretty close to center lane in overseeing markets. But given where what we've been, I don't expect anything in the double-digit range for 2020.
U.S. versus international. We've talked about the slow growth overseas, but that, there are signs that maybe that's bottoming out right now. Is that where you look for opportunity as well?
I think so. Seema was just talking about emerging markets, and yes, there are risks, but I will say, if you take a step back at these demonstrations, sure, near term, that is an economic negative if things aren't getting done. But if you look at what all of these protesters want, generally, more equal income distribution, that's pro-growth, because a dollar going to the lower income is going to be spent. A dollar taken away from the highest income will likely come out of savings. So that ultimately will be pro-growth. Right. We have a valuation spread between foreign and U.S. that's as wide as it's been in more than a decade. So I do think we're going to see the foreign markets catch up as long as economic growth continues, and there's no reason. I don't see a recession on the immediate horizon.
Jack Ablin with Crescent Capital. Happy holidays, my friend.
Yeah, thank you, Bill.
See you later. On to the economy now. Sales of newly built homes came in a little light in November. But as Diana Olick explains, builders are still poised for a potentially big year in 2020 if they can change one thing.
Home builders are incredibly bullish on their business right now, thanks to strong demand and a severe shortage of existing homes for sale. Home shoppers in November signed more contracts to buy new homes than they did in October, but October's numbers were revised down sharply. Still, sales were up a strong 17% compared with a year ago. New homes have now been selling at an annualized pace of over 700,000 for 5 of the past 6 months, the first time since before the recession. Much of the strength in new housing is being fueled by low mortgage rates, a full percentage point lower than they were a year ago. A new forecast from Freddie Mac says rates will hold where they are now, not only through next year, but also through 2021. The only thing holding builders back from even more robust sales is price. The median price of a new home sold in November was up a sharp 7% annually. This shift was due to an increase in the number of homes sold above $400,000 and a decline in those sold below $300,000. Demand is strongest on the low end of the market as millennials finally move from renting to buying. Unfortunately, that's not where builders are putting up the most homes. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, 3 dividend-paying stocks in a tough sector that our market monitor says you need in your portfolio in the new year. It has been quite a year for California's largest public utility, PG&E. That company has been reaching multi-billion-dollar settlements with wildfire victims and insurers and state regulators, but it still doesn't have the approval of Governor Newsom to participate in a state wildfire fund, which is seen as crucial to its survival. Jane Wells takes a look at what's next.
Everything burnt, everything was gone, except for what we took.
George and Joyce Meyer lost their home and business when fire barreled through the town of Paradise, California last year, an event caused by PG&E power lines.
Sometimes I wonder if you can put a value on all the memories, like my wedding bell or my mother's Afghan that she made my dad for his first anniversary present. I don't know how you put a value on that. I couldn't even imagine how to put a price on that.
This is what their properties looked like after the fire swept through. The Meyers are now in line with tens of thousands of other wildfire victims to be compensated by PG&E and a $13.5 billion settlement. Shares, which were decimated over the last year, rebounded this month with news of the potential payout, which was approved by the bankruptcy judge. Except the settlement, along with billions more promised to insurers, regulators, and cities, these are not a done deal yet. That's because PG&E's reorganization plan needs approval from several parties, and there is one big holdout: California's governor.
They're going to have to be completely reimagined.
Governor Gavin Newsom wants a whole new board for the company, and he's also concerned the current plan does not leave PG&E strong enough financially. Without his approval, California's largest utility may not emerge from bankruptcy in time to qualify for a new state-managed fund to cover the cost of future wildfire disasters. If that doesn't happen, all bets are off.
Unfortunately, if PG&E is liquidated and its assets sold off, it's likely that the wildfire victims would get very little, if anything, from those sales.
The Meyers have cleared their properties of debris, and they wait for money to rebuild, as PG&E says it's continuing to talk with the governor about an acceptable path forward.
I don't think it's going to be like hitting the lottery. I think a person should be very happy if you get back close to where you were.
Just want to go home.
For Nightly Business Report, Jane Wells, Los Angeles.
JP Morgan upgrades 3M, and that's where we begin tonight's market focus. The Post-it notes maker was upgraded to neutral from underweight. The bank cited potential growth in 3M's electronics unit, which produces fluids and abrasives used in the manufacture of computer chips. Price target there now $150. Shares were up nearly 2% today to $178.47. JD.com is reportedly considering an IPO overseas for its logistics unit that could raise up to $10 billion. Reuters reports that the Chinese e-commerce company is having talks with banks and targeting a valuation of at least $30 billion overall. Shares rose more than 2.5% today to $36.26. Brookfield Infrastructure is buying telecom service provider Cincinnati Bell and its institutional partners for more than $2.5 billion. Cincinnati Bell's network serves more than 1.3 million homes. The deal is expected to close by the end of next year. Shares spiked by more than 35% on that deal today to $10.45. And Sarepta Therapeutics has struck a licensing agreement with Swiss drug maker Roche in a deal worth more than $1 billion. Roche will now have exclusive commercial rights to Sarepta's gene therapy treatment for Duchenne muscular dystrophy outside the United States. Sarepta rose about 7% today, 7.5% really, to 135.58. All week, we're getting you ready for the new year by bringing back some familiar Market Monitor guests. Tonight's guest likes some defensive and dividend-paying stocks. Last time she was on a year ago, she recommended Visa, which over the last year is up 32%, MasterCard up 46%, and PayPal up 26%. We welcome back Marianne Montaigne, Portfolio Manager at Gradient Investments. Good to see you again. Welcome back.
Thank you, Bill.
This time the theme is energy, which of course has been a tough sector this year. It's underperformed most other sectors, and you're going for the dividend as well. We start with Exxon Mobil tonight. Why that one?
Right. Well, I guess just as a backdrop, as you said, energy has been a tough area. And we like the sector now because we like the defensive types of names. Right. And energy fits in there very neatly. So Exxon Mobil is an integrated global energy producer. They've had several projects in the work that will come on over the next couple of years to drive cash flow and sustain that 5% dividend yield, which some have called into question. We're pretty comfortable with that. And so we like Exxon Mobil.
Then a couple of ETFs, the XLE, the Spider Energy Select Sector. Why that one?
Yeah, so that's a broad-based energy play. We just think that the $60 plus oil prices right now are sustainable. We think that OPEC plus, the OPEC group plus others involved, will cut back on production pretty much in line with what they've already offered to us. So that's going to sustain that. And XLE offers a 3.6% dividend yield, probably going higher. A lot of companies have already cut back on capital expenditures to help drive their cash flow, and that's probably bottom. So we should start to see some more money move into the oil services group as capital expenditures start to turn up.
Finally, boy, here's one with a very attractive dividend yield, the Global X Master Limited Partnership ETF, 9.7% yield right now.
Yeah, you know, that's the sustainability of that income had been questioned in the past, and the valuation was cut in half if you look at it on an EV to EBITDA basis. So it's now selling at about 10 times forward numbers, and we do think that 9.7% yield is sustainable. So for people who are looking for an alternative to bonds, really the volatility is going to be higher than bonds, but it's not really higher than the overall stock market. So to have market type of volatility and 9.7% income alone, we think is very positive.
Marianne Montaigne, always good to see you. Thank you and happy holidays.
Good to see you. Happy holidays to you and yours.
Thank you very much. And coming up, the battle for your video game dollars is getting more intense. Are traditional consoles still the go-to gift for the holidays? As expected, Disney's latest installment in the Star Wars saga, The Rise of Skywalker, won the weekend box office. It pulled in $176 million. Now, while that fell short of the opening haul for the two previous movies in that series, it was still one of the biggest debuts of the year. Finally tonight, for the last several decades, many a kid, even an adult, has hoped for a video game console for the holidays. But the rise of mobile gaming and streaming has put a dent in the popularity of the traditional console. Josh Lipton takes a look now at whether this longtime staple of electronic gifts still has a place under the tree.
Will video game consoles be a hot holiday item this year? Maybe not. Shipments are expected to total 37.5 million units in 2019. That's a nearly 13% drop. Nintendo fans are still buying consoles, but Sony and Microsoft fans are putting off purchases because they know new ones are on the way. Both companies say their next generation consoles will be available late next year. Gamers expect them to be faster with better graphics. So which one has the edge? Analysts expect Sony to sell more new consoles than Microsoft because it boasts a bigger brand in more markets. But we can't know for sure, they say, until the companies unveil price points and games. The new consoles arrive at an important time for the industry. Analysts say mobile gaming continues to grow strongly, that there has been a resurgence in PC gaming, and there is the rise of game streaming services too, like Google Stadia, which for $10 a month allows fans to stream high-quality games to their PCs, TVs, and most Pixel phones. No pricey console needed. That's a potential long-term threat to the console industry, but it's one that the companies are well aware of. For example, Microsoft plans to formally launch its own game streaming technology next year, though the company isn't yet detailing price or an exact launch date. Sony and Microsoft have long battled in this console market, but they now see the advantages of working together too. Earlier this year, the two companies announced that they were exploring a new partnership, including Sony's use of Microsoft's cloud services for game and content streaming. For Nightly Business Report, I'm Josh Lipton, San Francisco.
And before we go, one final look at the day on Wall Street. The rally continued. More records. The Dow up 96 points. NASDAQ climbed by 20. The S&P was up 2. That is Nightly Business Report for tonight. I'm Bill Griffith. Thank you so much for watching. Have a great evening. See you tomorrow.